As a non-resident Indian, you can invest or continue with your existing investments in Indian mutual funds to benefit from the growth of Indian economy. However, there are some special rules and tax implications that you need to consider before investing in India. The mutual fund taxation rules are almost similar for both NRIs as well as resident Indians. They mostly depend on the type of mutual fund and your holding period. However, as an NRI, you may have to abide by some special rules regarding TDS and your DTAA. In this video, I mainly want to cover what are the TDS rates on your mutual fund investments. That means, if tomorrow you plan to redeem your mutual fund investments, what are the taxes which will be deducted immediately when you remove your investments? So let's get started. So tax rates for equity-oriented mutual funds for NRIs are in the table below. As per Section 111A of Income Tax Act, short-term capital gains on transfer of units before 23rd of July 2024 of equity-oriented mutual funds are taxable at 15%, and for transfer on or after 23rd of July 2024 shall be taxable at 20%. Again, as per Section 112A, long-term capital gain tax applicable on transfer of units of equity-oriented mutual funds before 23rd of July shall be taxable at 10%, and on or after 23rd of July shall be taxable at 12.5%. Now remember, generally you will see that the TDS rates are same as the tax rates applicable for NRIs. TDS rates for specified mutual funds for NRIs, which includes debt funds, gold funds and bond ETFs. In case of gold funds or debt funds, capital gain on transfer of units of specified funds shall be taxable at applicable income tax slab rates, but unfortunately the TDS in this case is almost 30% for NRIs. So make sure if your incomes in India are lesser and there are higher TDS deducted, then you need to take this TDS refund at the time of tax filing in India. Also, if your TDS deducted is in the range of double-digit lakhs, then I would highly recommend that you go for a lower TDS certificate, which will help us have more money in our hand and less taxes deducted at source. On the same lines of taxes and TDS, there are two more points which you should keep in mind. The first is, there shall be no TDS deductible if the dividend paid or credited from your mutual fund investments is below 5,000 rupees in a financial year. Point 2 is that tax to be deducted at source at the rate of 20% or at the rate of specified under the relevant double tax avoidance agreement, whichever is lower as per the section of 196A. Hope this was helpful. Share this with other NRIs and let me know if you need any help. Thank you.